Hello, this is Coleen Trimble. I'm your host for today's DC presentation on the SECURE Act and Guaranteed Retirement Income. As many of you probably know, the SECURE Act was really the most important retirement reform legislation since the Pension Protection Act of 2006. And so for that reason, we've invited two speakers from Principal Financial Services that I think will be able to give us really good insight into those key areas. Lance Schoening is the Government Relations Director with Principal in Washington, D.C. Lance is going to share his insights on this important legislation. And what I find most intriguing is that his firsthand dealings came from those who actually wrote the legislation. So with the SECURE Act and the protections that it perhaps provides, we hope provides, in-plan annuity options will become an option that plan sponsors and consultants may very well want to evaluate. So therefore, we're also very pleased to introduce Brett Fisher, who is the Director of Investment Development at Principal. And Brett's going to give us some ideas in terms of what solutions are available and what to consider when adding these options to plans perhaps in the future. So then lastly, after the presentations, we'll follow up with a brief Q&A session. So with that, I would invite Lance to present. And Lance, we appreciate you being here. We look forward to your insights.
Great, thank you, Coleen. Welcome everyone. And thank you for the opportunity. This is a particular project that I've invested personally years of my career on, so it's a very close to my heart and my profession here. So I'm going to go ahead and kind of share our presentation. And it's kind of interesting that given the events of 2020, how we kind of can lose perspective on everything that's occurred this year. I saw a meme the other day about the events of 2020. And it was a picture of an infomercial hawker, one of those presenters. And the caption was, "But wait, there's more." And that's certainly a good reflection of how I think all of us perceive 2020. It just seems like one momentous development after another. And it's easy to lose perspective that just earlier this year, the US Congress passed the first major retirement reform since the Pension Protection Act. And so what Congress was really attempting to do here was address a number of key shortcomings to our system, which, our system is a very solid, successful system, but obviously there are many things that are needed to continually advance our system and make it better for American workers. And particularly, I think with the COVID crisis and the impacts on both interest rates and the markets, it's demonstrated that we need to encourage both plan sponsors and working Americans to leverage guaranteed income products to a greater degree to protect their retirement income through these times of just incredible volatility. So as I mentioned, this is an issue that's very close to my own heart. It's an issue that not only I, but other members of the Principal team have been working on in Washington, D.C., going back nearly a decade. And in fact, what you see on the slide are pictures of both myself and my boss, Joni Tibbetts, who's Vice President of Product Management in the Retirement Division at Principal, testifying in front of different Senate committees at different points in time on the same issues, issues of retirement adequacy, participation, sponsorship, as well as the key issue of longevity and retirement income. It's amazing looking back at how long it does take to get some of these key reforms made in the democracy that we have in place. But the founding fathers were very clear in establishing a system that does make it difficult to pass new law. So what that entails or requires is that we have a continual presence in DC. So we maintain a staff of dedicated people that are working on the Hill on a daily basis. I've had the benefit of being able to work side by side with them for the past 3 years directly in DC. The rest of my career, and I think most of my career going forward, will be spent in our headquarters in Des Moines, but still working on advocacy. As we do this, we work very closely with trade groups in Washington. Some of the key trade groups we work with include groups like the American Benefits Council, SIFMA, the American Council of Life Insurers, as well as others. And when we're working on advocacy for particular policy, typically that entails working through trade groups to get some type of consensus amongst industry members. But at other times, we also work directly. So Principal will directly interact with members of Congress seeking specific new enhancements or changes to existing law. So as Congress looked at the SECURE Act and really what was needed going forward in this country and looking back to the last reforms that were made, major reforms in the Pension Protection Act, there were really 4 key objectives that Congress is seeking to achieve. And so those include improving access to retirement savings in the work site. And that's done through various increased incentives, new incentives to sponsorship for particularly small businesses where the gap of having access to a retirement plan is more pronounced. But also they looked at increasing participation in existing plans, as well as improving savings adequacy. What are those things that help people save more? And then finally, what we're going to focus on today is longevity. So people are living longer, they're having longer retirements, and we need to find ways to provide more lifetime income that can essentially help someone translate that retirement savings into an income stream that's going to last throughout their retirement. So again, focus specifically on lifetime income. The SECURE Act really addresses key barriers that have existed for many years to the adoption of in-plan income solutions. So taking one of these types of products or solutions and putting them inside a retirement plan. And so what the SECURE Act really does is it focuses on providing now for the first time a reasonable and workable fiduciary responsibility set for evaluating insurers for the purpose of including a product in plan. By doing so, it's providing additional protection for fiduciaries from fiduciary liability, and I'll talk about that in a bit. In addition, kind of the final barrier that's existed is portability. And what the SECURE Act does is it allows portability of purchased income. So for an individual who's actually purchased guaranteed income in their plan, it allows that individual to port those purchased income amounts in the event that the fiduciary of the plan makes the decision to discontinue the product or the provider at some point in the future. So important to note that there is an actual definition for guaranteed retirement income contract in the SECURE Act, and it entails an annuity contract for a fixed term or a contract or a provision or feature thereof, which provides guaranteed benefits annually or more frequently for at least the remainder of the life of the participant or the joint lives of the participant and the participant's designated beneficiary as part of an individual account plan. So very specifically, these are contracts that are backed by an insurer, offered by an insurer to provide those guaranteed lifetime income streams. So getting down to the really nitty-gritty of this provision, it what it does is it offers a new optional safe harbor for the selection of a lifetime income provider. And the requirements for this safe harbor start with essentially the engagement in an objective, thorough, and analytical search. And I know this is something that DeMarche is very familiar with. It's something that you do every day. But through that search, what the SECURE Act is basically requiring is that the fiduciary then further consider the financial capabilities of the insurer to meet their obligations under the contract, and additionally that the cost of that contract is relative to the benefits and features and administrative services that are offered. So that last consideration is something, again, that's pretty consistent and utilized for other types of aspects of a retirement plan offering. The first consideration, the financial capabilities of the insurer, that's something that's, again, really specific to these types of contracts. And it's been, again, a barrier that's existed in that many fiduciaries really don't have the capability to evaluate an insurer's financial capabilities. And so, again, there's something that the SECURE Act has offered to help solve that. So going on here in terms of the obligations of the fiduciary, based on kind of the evaluation of those key considerations, the fiduciary should conclude that at the time of selection of the insurer, that insurer is financially capable of meeting their obligations under the contract, and that the relative cost of the selected contract is reasonable. So getting back to that kind of unique situation where the fiduciary must examine the financial capability of the insurer to meet their obligations under these contracts, what the SECURE Act does is it lays out a very specific and reasonable set of requirements that the fiduciary must follow. And what that entails is the fiduciary must obtain written representations from the insurer showing that for at least the last 7 years, the insurer meets these criteria that's listed. And they include that the insurer is operated under a certificate of authority from the Insurance Commission that hasn't been revoked, that they filed audited financial statements, that they maintain satisfactory reserves for all the states where the business is conducted, that they're not operating under an order of supervision, rehabilitation, or liquidation, and then finally, that they're undergoing, at least every 5 years, a financial examination by the Insurance Commission. So essentially what the SECURE Act and what Congress has done here is they've said the typical business owner simply doesn't have the expertise to be able to evaluate all of these kind of unique aspects relative to an insurance company's financial status. And what they've done is they've relied on the state insurance commissions, which have a very rigorous regime to do that. And so essentially, plan fiduciaries now have the benefit of being able to rely on all of that work that's done by state insurance commissions and essentially obtain these written representations from insurers that demonstrate that they've met the key criteria. And as such, the fiduciary can meet their obligations under the contract. Now, an important distinction here is that the safe harbor that's afforded under the SECURE Act addresses the selection of the insurer. It does not address the selection of the actual product. But the key thing to remember here is that the product selection process really doesn't have to differ from that used for any other investment product. So as you're going about evaluating the actual product, the key here to understand is that it's important to assemble the relevant data about the particular option, assess that data, make an informed and reasoned decision, and then finally document the decision and revisit periodically. So it follows those typical obligations of fiduciary prudence in terms of conducting that particular process of evaluating a product. And Brett's going to kind of help lay out some additional considerations in terms of, if you have various products you're evaluating, how you actually approach that process. And then finally, I want to hit on the kind of last barrier that I mentioned, and that is lifetime income portability. And so the challenge here has been that if a fiduciary who selects one of these products for their plan at some point in the future makes the decision that due to their fiduciary obligations, they need to either discontinue that product or they need to change providers. That can create, under prior law, a taxable event for an individual who's purchased that guaranteed income because it doesn't port. So what the SECURE Act does is it addresses this challenge by allowing the balances to be transferred penalty-free to either a qualified distribution annuity contract or to another qualified plan or IRA. So essentially it allows an early distribution of those amounts to an individual product or to another plan to allow that individual to remain whole and not experience that penalty. So this is something that weighed very heavily on plan fiduciaries. They certainly, in terms of our experiences, we had discussions with plan sponsors, were uncomfortable with the idea that one of their employees who might purchase this income product for themselves might be penalized at some point in the future because of a decision that the plan sponsor is obligated to make. So this really addresses that key problem, and we hope that the collection of all of these aspects under the SECURE Act are going to help really change the dynamic and encourage greater adoption of these products going forward in the future. So with that kind of gives you an overlay of how the SECURE Act is supporting the kind of furthering of the providing of guaranteed income in plans. I'll pass it to my colleague, Brett Fisher, to talk more about what types of products exist in the marketplace and further, what are your considerations in terms of evaluating these products?
Great, thank you, Lance. And again, I'll echo Lance's comments. Thank you, everybody, for the opportunity to speak with you all, albeit virtually. Certainly hope that yourself, family, and friends are staying safe and sane during this time. And I always joke about the sane part because I am at home with a 4 and a 2-year-old, and so the sanity is running out quickly, especially on certain days. So, I wanted to take a quick step back here as Lance went through all that great information, and the question, before you get into kind of the product landscape is, well, geez, why did we fight as an industry so hard for these types of products to be allowed in plan and to really give plan sponsors a fiduciary comfort level in selecting them? And I always go back to this survey, and you can see on the left-hand side here, the biggest concern when you talk to employees is that when they're in retirement, they're going to run out of money. In fact, you always hear some anecdotal things when you talk to people, and not to make light of death, but people say things like, I'm more afraid to run out of money than I am of death because I've worked so hard my entire career, and when I'm done, that's just something that really concerns me. And then when you kind of look in the middle there, plan sponsors, a resounding response to, they would really like to do something to help their employees have investment options that give them guaranteed retirement income. So when you kind of look at both sides of the equation, it was certainly incumbent on us as an industry, and certainly going one level deeper at Principal, to say, what can we do to help kind of the American workers not have this fear as they enter their retirement years. So again, prior to the passage of SECURE Act, I do want to make a point that there definitely were providers in the industry that had developed these guaranteed retirement income products, and it started to gain some traction with them. Even without the SECURE Act, had done a really nice job of getting plan sponsors and fiduciaries comfortable with offering these products. And typically what you saw is these companies were firms that had a record-keeping platform and also the ability to offer a product. So also had an insurance aspect to their company. So for example, Principal would have been a company like that. I think as you look forward, the provisions within the SECURE Act making these products much more viable in the marketplace, it's likely we're going to see providers enter this market that hadn't before and may look to partner in different ways. And so for example is, we may see asset managers partnering with insurance companies or pure play insurance companies partnering with record keepers. And I think an example of this that has been out in the news lately is BlackRock, which is a pure play asset manager, has partnered with Bright House Financial, which is a pure play kind of insurance company, to bring a product to market. So again, I think the market will continue to grow with these products, and certainly that can do nothing but the more products you have out there, that kind of competition brings about the best in everybody. So that's something that we certainly would anticipate seeing as the SECURE Act continues to gain foothold out in the marketplace. Maybe diving just a little bit deeper, there are many ways to structure a retirement income product, similar to structuring any type of investment product. I'll use the example of target date. There's many ways to structure your glide path. Is it to or is it through? What are your equity and fixed income allocations? What I'd say in the guaranteed retirement income product market right now, there's probably two predominant strategies in the marketplace today, and those will probably be likely to be kind of the predominant ones into the future. And those two are one that is a deferred income annuity, or commonly referred to as a DIA, and the second is a guaranteed minimum withdrawal benefit annuity, or commonly called as a GMWB. So I wanted to take the opportunity to take a closer look at both, so that as plan sponsors, as you're out there evaluating products and you come across these, again, which are two of the more common ones, there's some kind of key criteria to look at and differences between both. And as I kind of start at the top there, they both have the same goal. They are providing a guaranteed stream of income for a person that they'll never outlive. So again, going back to the target date example, a target date product, no matter what provider or what strategy you undertake, is there to make sure that someone has enough money as they reach their retirement age. So the general thesis is never bad between that. A target date product is there to help you. And going back to these two products, the general thesis is not bad. They are both trying to get you guaranteed income through your retirement. Now, the ways they go about that are different, and that's kind of where we're diving into the product. Some plan sponsors and fiduciaries may have preferences for one way over the other. So maybe going, a little bit deeper, with the DIA, there's no market exposure. Said another way, there's no market volatility. Every time you purchase a piece of a DIA, immediately what that retirement income you're getting in the future is. So for an easy example, if a plan participant were to invest $100 today, they would know that gives me $110 of retirement income in the future. So it's a known quantity at that time. A little bit different with the GMWB is typically there is an underlying investment, maybe an index product or a target date product, where there is potentially some market volatility fluctuation, but generally it will never fall below a minimum percentage of income that's laid out in the contract. So again, there's maybe the chance for a bit more upside than with the DIA, but again, the DIA is probably a little bit more straightforward in some terms because you know exactly what you're getting when you make your investment. And that also then plays directly into how the fees work on these two types of products. In the DIA product, that fee is already calculated when the provider is telling you how much income you're getting in the future. So that fee is baked into that. With the GMWB, really what you're doing is you're paying on top of your investment for that security of knowing you'll never fall below a certain percentage. So I always kind of, you know, as an example, say maybe you've invested $100,000 into a GMWB, and for every 100,000 you invest, you're paying $1,000 of quote unquote insurance to make sure that you never fall below a guaranteed stream of income, while also potentially getting some access to the upside. So again, there is a, you know, an implicit fee with the DIA structure and an explicit fee with the GMWB structure. When you look at the liquidity features of each, a deferred income annuity will always allow for liquidity. The one caveat there is there's typically a set amount of time where a surrender charge will apply or won't apply. And to take an example, let's say a provider has said, you invest money into our DIA. If you want to take that money out before 90 days, you're welcome to take that money out, and there will be no penalty or charge for doing that. Past that 90 days, if you want to take that money out, we will have to calculate some sort of surrender charge based on market conditions, interest rate environment, et cetera, that could result in the money you invested not being returned to you in full. So example, you invested $100, there is a potential that maybe you get 99 back. With the GMWB, you'll always get that principal investment back in the form of liquidity whenever you want it. However, that kind of insurance or that payment we talked about under the fee structure, that explicit fee, that is never returned. That payment is always going to be kept by the provider and will not be part of getting your investment back if you have a liquidity situation. And then lastly, both structures allow for different payout options. When we go to the GMWB side, typically what you'll see is it's a couple options. It's a single or joint lifetime income payout option. And a single lifetime income option is, you know, I, Brett Fisher, am a single person and I don't have any dependents. So that's this, you know, when I die, my payments stop. Joint lifetime income is if I have a dependent, I'm able to designate that person as my dependent. And when I pass away, that dependent gets to take over the payments of the product until they pass away as well. So allows for some flexibility there in terms of how to structure and get payments. A DIA allows for both of those as well, but typically also allows for many more unique payment options. And we won't get into those today. But there are certainly many options that you can choose that fits kind of your situation. The one thing I'll say that always differs between payout options is depending on how unique you get with it, it can impact the amount of retirement income you actually receive in the future. So the more simple payout option, the more income you're likely to get. Maybe the more unique or complex payout option, it may lessen that income stream in the future. Because again, you're getting a little bit more benefit out of how you're getting paid out from that product. Sorry, I went ahead one slide there. So again, I wanted in conclusion just to talk about again, and really going back to Lance's comments, that really what SECURE Act does in a nutshell is creates a clear path for the usage of retirement income products within retirement plans for plan sponsors or fiduciaries. Because again, it's providing workable and reasonable fiduciary responsibilities and evaluating providers. It's protecting fiduciaries from those future liabilities. And then a very key point is that it allows for portability. So again, I always come back to SECURE Act essentially made it easier for plan sponsors to account for the number one worry of their employees, and that's not running out of money in retirement. And so again, as an industry and as a company at Principal, we couldn't be more thrilled with the SECURE Act. And as it takes more of a foothold in the future, we are very positive that it will be positive for American workers going forward.
Thank you so much, Lance and Brett, for your presentations. Are you both open for a couple of questions?
Absolutely.
Absolutely.
Great. So, you know, the safe harbor protection piece is obviously critical, and that's sort of the bottom line here. And I just want to be really, really clear for our audience. So I'm going to ask a very basic question. Will a plan meet the safe harbor provision if they simply choose a provider who is in good standing with state and federal
you have to.
regulators?
Yeah, it's a little more entailed than that, Coleen. First, under the law, the fiduciary must conduct an objective, thorough, and analytical search to identify those insurers. So as part of that, you'll want to make sure that you have good documentation, that you've gathered sufficient information to do so. With that search, then the fiduciary must evaluate two key factors. First is that insurer's financial capability, and then second, the cost of the contract relative to the benefits, features, and services that are offered under that contract. And so the objective then is for that fiduciary to conclude that the insurer at the time of selection is financially capable of meeting its obligations under the contract and that the relative costs of the contract are reasonable. So what the safe harbor really does is it addresses that most challenging aspect of the analysis for most people, which is the determination of that insurer's financial capability. So what the SECURE Act does, again, is it leverages the work performed by the state insurance commissions for this particular piece and allows the fiduciary to meet those obligations by obtaining a set of those required representations from the insurer that demonstrates that the insurer meets the minimum required financial capability standards under the SECURE Act. So that's really what the safe harbor does. It helps make that particular analysis and determination more workable and reasonable.
Okay.
And Lance, you correct me if I'm wrong, but I think what we'll see and have been seeing is that providers are kind of gathering that information and making it very easy for plan sponsors and fiduciaries to get by saying, here is quote unquote everything that you've been asked for and we've prepared it for you and here it is for you to evaluate.
That's exactly right, Brett. And you'll see that from Principal as well, obviously.
Yep.
So as a follow-up to that, are either of you familiar with any sort of a template that others are using or are establishing to look at the product side of an annuity? So it sounds like that we've got the insure piece, set forth, and that looks pretty straightforward. And plan sponsors would be clear for plan sponsors or consultants to know, okay, this is our checklist. This is what we need to do. When you look at that second level of due diligence, when it comes to the product level, again, are you all familiar with any kind of a template that's being established as a sort of a go-by?
So Coleen, I'll jump in here. I think what we've done as an industry now is we've taken care of that first problem, which is, how can we get comfortable having these products in our retirement plan? And I really liken it back to target date in the PPA, where then it said, okay, target date is an acceptable QDIA. Let's have, in my world, the more fun conversation. Why are certain products potentially better than other products? In that piece, there has just not been a lot of conversation in the industry before because it just hasn't been widely accepted that these products should go into a plan. So it's typically been, there may be a one-off consultant, advisor, plan sponsor who's interested and they kind of do their own analysis. What I've seen is I've had more phone calls outwardly with the market, and I do believe that firms, even potentially like DeMarche and yourself, will come up with templates like that they believe work. I've yet to see one that probably resonates within the industry, kind of standardly like you might be able to do with a target date product, for example. So I think when a firm is able to provide that value add, it will be huge for their clients, because kind of standardizing that information and creating some sort of comparison tool would certainly be very, very helpful.
Yeah, I totally agree with that. Okay, great feedback on that. Thank you. So my next question goes back to the fact of this safe harbor. We noted there will be a safe harbor in terms of the selection of the income provider, provided the search process identifies that fees are, quote, reasonable, right? That's a big and important term. Does the SECURE Act go any further in terms of helping plan sponsors understand what reasonable really is so that they don't end up feeling like they have to buy the cheapest provider?
Yeah, great question, Coleen. And, there is some helpful guidance, but the SECURE Act specifically does not define what reasonable fees are.
Okay.
And, as an industry, we probably don't want the government to make that a formal definition. It's like, be careful what you ask for, I think, in some of these cases. But what the SECURE Act does provide is very helpful language that confirms that there's no requirement that a fiduciary select the lowest cost contract. And the fiduciary may consider the overall value of the contract, which includes the benefits and features, as well as the attributes of the insurer. So while the safe harbor kind of allows the fiduciary to obtain those representations that shows that the insurer meets the minimum requirements for financial capability, it's certainly within the purview of the fiduciary to evaluate all of those insurers and determine that a greater financial strength is going to add to the value of the contract. So you look at all of those things in conjunction with the cost of the contract. That's important. So, and to clarify, the cost of the contract does include fees as well as commissions. So it's kind of a holistic view of the cost under that contract.
Okay, thank you. Brett, did you have anything to add on that question, or was that covered?
No, I think Lance did a great job. I'd probably just tie it back to my previous comments that, again, as consulting firms figure out that template, the ability to show those differences in value adds and costs, benefit, features that's a huge part of it for sure.
Mm-hmm. I would concur. I think my last question here is just more broad in general in its scope. So from my perspective, we have seen limited implementation of in-plan annuities, and we know that's been in part due to lack of transparency in the past or complexity and a host of other issues. And that's what's being addressed today in part with the SECURE Act. And yet we also know that current surveys, no matter what survey I look at these days, it's showing that participants do want the opportunity for guaranteed income. So philosophically, they're saying this is what I want. So while the SECURE Act is a very important first step, what additional steps must be taken by Congress or the financial services industry and plan sponsors in order to make in-plan annuities become a reality? And I pose that to each of you.
Maybe I'll start with that. And, unfortunately, over the years, I think, to some extent, annuities have gotten a bad rap. That primarily because of complexities. There are many different types of annuities that serve very different purposes, have different fee structures. And as a result of that, and the fact that, that there isn't a corresponding mutual fund type of disclosure template around, annuities, it's created this kind of perception that these products are not only complex, but they're expensive, that they favor, a particular insurer over a client. And, in my opinion, that couldn't be farther from the truth. What these products do is they take risk off of an individual's plate. And so they serve a very, very important purpose for specific situations. They don't serve every situation, and that's very important, but they do serve specific situations very well. And what we've seen ourselves in terms of individuals who have access to guaranteed income in their retirement years, that population is more satisfied with their retirement and the condition of their retirement than those that don't have guaranteed income. So I think for one, we as an industry have to help change that perception amongst consumers that these products ultimately are great options for specific situations and specific needs. So it's incumbent, I think, on us to help do that. What Congress, I think, has done here is it's really kind of opened the door, the pathway to greater usage within plans, within worksite offered retirement plans. And I think if we can get some traction going in this environment, that will only help to kind of build further momentum amongst consumers in terms of their opinions of annuities and guaranteed lifetime income products in general.
Yeah, I think that's all spot on, Lance. If I take it to maybe a layer down into the actual product space, I think one thing that is incumbent on us as an industry is providers figuring out how to pair these products with something like a target date or potentially a target risk product, where it's a QDIA, and we know that many participants who aren't as engaged as potentially they should be leading up to their retirement years are getting access or exposure to these types of products that are essentially solving the problem for them along the way. And I think that type of product structure is something we will see more of in the future, in the years to come, and could really serve a great benefit to the general majority of workers who, save their money every week, get their employer match if there is one, but don't really know how to do it themselves. They stay in the QDIA. They hope that the target date gets them where they need to go. And then again, when they get to 65, it's kind of, oh, what should I be doing now? The ability to build in retirement and guaranteed retirement income years before they reach 65, I think would be of great benefit as well.
Yeah, I agree with that, Brett. I think there have been a couple of target date fund strategies that have built in some sort of an annuity. I'm not sure what the status of those are today, but I certainly philosophically agree with thinking about the entire lifespan of the employee. The target date funds have taken us a long way in terms of improving plan participation, et cetera. So I do think that may be something that will come more into the future. So with that, I'm just going to ask if either of you have any closing comments or thoughts to leave our audience today before we wrap this up.
I'll start. I just want to express my thanks to DeMarche for reaching out. This is such an important topic to the overall retirement security picture in the United States. It's something that as defined benefit plans become less and less available to American workers, we need to solve this issue. And I think this is an important first step. And I'm so happy that you reached out and set up this call. And I just hope that other financial consultant and advisor firms take as much attention and focus on this topic going forward. As I think, again, we start to socialize more of these SECURE Act reforms and determine how they could potentially benefit retirement plan participants. So again, thank you, Coleen.
You're welcome.
Yeah, I'd echo that. I commend DeMarche for being on the forefront of this and allowing Lance and myself to speak about this type of topic, which we love doing. So I think it's great, and I thank you again.
Well, you're welcome. And I really appreciate Lance and Brett, you participating today as DeMarche continues to explore this area just like everyone else is. And we all have a lot of work to do, but it's important to start these conversations and just starting to become familiar. So again, I want to thank you both. Stay well. And I believe that concludes today's presentations. Thanks again.